Hello, very good evening. Today I'm going to start with accounting of business combinations and restructuring. It is part of a section B and study note number 2. So this chapter comes under Ind AS 103. Ind AS 103 deals with business combinations. So there are various types of mergers, okay, and practical sums we'll be discussing on merger, demerger, business combination under common control, internal reconstruction. So all these topics will be covered. So first, let us have a glance on the introduction of this chapter today. What is business combination actually? See, it is a transaction in which an acquirer obtains control of one or more business. Okay, the acquirer obtains control of one or more businesses. Now, when I say acquirer, okay, let us take this example. B. A is investing 40% in B. Second example, A is investing 10% in B. Third example, A is investing 45% in B. Okay. Now, 40%, 10%, and 45%. Now, these three cases, can this be called as an acquisition? Can this be called as there's control? No. As per Ind AS 103, when do you call it as a control? Means it must be more than 50%. Okay. So these three criteria, this 40, 10, 45, doesn't come under the purview of the word control or acquisition. So when the investment or when acquirer is investing more than 50% in the acquiry, it is called as control. It is called as an acquisition. So now here A is called as the acquirer and B is called as the acquiree. So what is control then? Control is just the power over the investee. A is having the control on B. A is having the power on the investee B. Okay, so this was the first meaning or the understanding of the word control or what is this combination is. So an acquirer obtains control on the acquiring, right? So let us proceed further. The definition of business combination. A business combination is a transaction in which the acquirer obtains control over the business. What is an acquirer? Who is an acquirer? The acquirer is an entity which obtains control and pays the consideration. The assets and liabilities of the acquiree, that is a business, is fairly valued. Normally, the investor is the acquirer. However, in case of reverse acquisition, we need to be careful in determining the acquirer and acquiree. Reverse acquisition is a separate topic wherein the acquirer and acquiree may not be the same. Okay, so let us not go into that topic. So basic things we'll understand first. So as such, the company which invests in the investee, okay, it is called as the acquirer. Okay, the assets and liabilities are fairly valued, which means the value of the assets and liabilities when it is taken over, you will take them only at the fair values. Okay, book values are not considered. You will take them only at the fair values, right? So investor-investee relationship results in that investee company getting liquidated. The investee company is getting liquidated. Now the acquiree will not exist anymore. Okay, in that case you call it as a business combination under Ind AS 103, right? So I'm proceeding further. We need to understand certain terms. What is control? So we discussed just what control is, the power over the investee. So let us go in detail. What is control? Generally, control is obtained when investor acquires more than 50%. That is what we saw in the beginning, right? Now, as such, Ind AS 110. What is Ind AS 110? It deals with consolidated financial statements. Okay, there they have given the definition for the term control. A parent controls the investee if it has power over the investee and is exposed to variable returns from its investment, and it has the ability to affect those variable returns through its power over the investee, which means the amount of power, okay, the amount of investment he has made, but the power of the investee should be in such manner that it must be able to influence the variable returns from the investee. Okay, why it is variable returns? If it could be fixed returns means then it would turn out to be a contract. There will not be any control. So it is called as variable returns. So three things we have to understand here from the term control. First thing is what? Power over the investee. The acquirer should have the power over the investee. Secondly, it must be exposed to variable returns. Thirdly is what? The ability to affect, the influence, the power, the ability to affect the variable returns through its power. Right? This is what is the exact meaning of the term controllers. Okay. Now, the first term we called as what? Business combination, right? But first we need to understand what is this business actually. We know combinations are no mergers, reverse merger, demerger, everything we know the terms. But what is business actually? A business is an interrelated activity and asset that is capable of being managed for the purpose of providing returns. When I say returns, it may come in the form of dividends, share of profit, reduction of cost, etc. Now, a business is different from the asset acquisition. What is this business all about? Okay, we just said that it is interrelated activities, right? What is it? There must be an input, there must be a process, and there must also be an output. Input is your combination of assets. Process is a system involved there. Output is the final outcome or the economic benefits being derived. So when input, process, and output is there, it is called as a complete business. So when you say you acquire a business, you should check whether there is an input, process, and output. Normal buying of assets is called as an asset acquisition. Let us discuss few examples so that you can differentiate what is asset acquisition and what is a business acquisition. Let us go ahead with the examples. Supposing you go to a supermarket. Okay, everybody knows how a supermarket will be, right? You're buying items there in the supermarket. You're buying fridge, all the provisions or even the computers which are being used for the billing. You will have seen, various counters, computers will be used. So everything, all those assets are there. So fridge, AC, everything you're buying. Individually you're buying. Is these buying of these items is called as a business acquisition? No, it is definitely no. These are asset acquisition. They are not business acquisition. These are asset acquisition because a business is different from asset acquisition. And Ind AS 103 deals only with business combinations. Okay, so to prove that it is a business, what are the three things you must remember? It should have an input, a process, and also an output, right? We'll discuss one more example. Same, we'll take supermarket. Okay, supermarket is there. There are two divisions. Okay, one division is dealing with grocery, and another division is dealing with garments. Okay, supposing you are buying the garments division. Okay, you leave with grocery. You are buying the garments division. Now tell me, is that a business acquisition? Yes, it is a business acquisition. How come? Garments, which means you'll have input of items. There must be a process, a proper system will be there, right? Output of the benefits, economic benefits will be derived. So it is a business acquisition. So when you acquire the business, you pay some money. Normally when you go to market, you buy any item, you pay money, right? The same concept. You're buying a business now. You're buying one entity, right? So the business you're acquiring, you pay some money. That money is called as what? Consideration. The term uses what? Consideration. Now, this consideration can be in any form. It can be in cash, it can be in any kind, it can be in shares also. That is different. But the acquisition part should always be a business to come under the purview of Ind AS 103, right? Similarly, one more example. You're purchasing a cinema hall. It is a business acquisition. Cinema hall consists of the theater screen, chairs, and everything. But it is a business acquisition because when you buy a business, it is not just the asset, the workforce, the activities involved, everything you're purchasing, right? So it is called as a business acquisition, right? So let us go further in deep inside how to account for this business combination. There are few things we have to understand. First one is identify the acquirer. This is very important because in case of reverse acquisitions and all, there is a they have some understanding of accounting acquirer and legal acquirer. They may not be the same. So first thing is we have to identify the acquirer. Who is the company which is acquiring the business? Okay. So as we discussed, who is an acquirer? Acquirer is an entity that obtains control. Acquirer is an entity that obtains control of another entity. Then who is an acquiree? Acquiree is another entity on whom the control is established. Acquiree is another entity on whom the control is established. Okay. So you need to identify the acquirer. This is the first step. The second step is what? Determining the acquisition date. Acquisition date means the date on which the business is being acquired. Why is it so important? Because assets and liabilities of acquiree is determined as on the date of acquisition. So second step is what? You need to determine the acquisition date because that date only are going to identify the assets and liabilities. Okay, fine. So third step is what? Recognition of assets and liabilities. Recognition of assets is supposing A is an acquirer. Okay, B is an acquiree. A is acquiring the business of B. Now, B will be holding the assets and liabilities. Okay, so B is holding some assets. Okay, now A may not be interested in all the assets of B. Okay, so A will identify only those assets which has economic benefit. So only those assets are identified which are recognized by the acquirer that will be considered for the business combination, right? So let me give you an example for this. Supposing A is an acquirer. Okay, just visualize the example. B is an acquiree. B is into pharmaceutical. It is into research and development phase. It is doing a pharmaceutical business. A is also to the same line. Okay, now A is acquiring B. Supposing in B's books, there are so many assets. Okay, there's one such asset. It is not fully done. So B feels that they don't want to identify it as an asset. Who is feeling? B is feeling. The acquiree is feeling that the asset is not fully done. So let us not declare this as an asset. That is what the acquiree is feeling. Now come to acquirer. Acquirer is going to take over the business, right? Now the acquirer is feeling that there is some benefit from this asset. Okay. Since both the companies are on the same line, A is feeling that they need something. Okay. But I have that resource so that I can make that process complete. Right. The thing is, A's purview is B doesn't have that know-how to develop the asset. B doesn't have the ability to develop it. But A has it resource to do it. So A is identifying that asset. Okay. So now did you understand? So those assets which are identified by the acquirer, those will be considered. Okay. So what was step number 1? Identify the acquirer. Step number 2 is what? Determine the acquisition date. And third is what? Recognition of assets and liabilities. So you have identified assets and liabilities. Yes. Now what's the next step? The assets and liabilities will be measured and recorded at fair value. Okay. Book values you should not consider. But in case the question is silent, There's no other option. We have to assume that the book values are your fair values, but as such, practically, only the fair value of the assets and liabilities are measured and recorded. Okay. Now, who will give us those fair values? We have some experts to give those values. Okay. They can be a valuer. Sometimes it can be outsourced. We all know actuary, right? You would have come across the term actuary. So the assets and liabilities which the acquirer has identified, no? So the acquired record must be identifiable and he will value them at the fair values. Right? So it is not necessary that those assets and liabilities are already recorded in the books of the acquiree. So it is not necessary at all. The acquiree has recorded these assets. So I have to take over those assets. Not at all necessary. Okay, it is acquirer's intention to identify the assets and liabilities of the acquiree. Okay. 3 steps are done now. The fourth thing is what? You're purchasing. You have to pay money, right? So recording the purchase consideration. The payment of purchase consideration must be measured at fair value. Ind AS, everything is at fair value. Okay, we will be studying so many Ind AS, but everywhere we'll be using this term fair value, fair value. Okay, so get used to this word. Now, if payment is made in cash, no problem, right? So its fair value is the amount paid. Whatever the amount paid is a fair value. Supposing if the payment is made by issue of shares, okay, or in kind, whatever it is, in that case, fair value needs to be measured. So you're purchasing the business and now you're going to pay the amount. The amount is called as what? Purchase consideration. Now comes another interesting topic. Now, the value of the business will be some X value. The amount of consideration you pay will be some other value. In that case, there will be some difference, right? So, determination of goodwill or gain on bargain purchase. Okay. See, these terms somewhere or the other you would have come across in AS 14. Okay, AS 14 was dealing with amalgamations. You would have come across these terms, no? Acquirer, acquiree, this percentage, goodwill, purchase consideration, assets, everywhere these terms and all you would have already come across. But now we are going to discuss only under Ind AS 103. Okay. So how to arrive at this goodwill? You're going to compare. What you're going to compare? Purchase consideration, non-controlling interest, and fair value of assets and liabilities. Okay. Purchase consideration, non-controlling interest, and fair value of assets and liabilities to determine what? Goodwill or capital reserve. Instead of capital reserve, I'm going to use a term as what? Gain on bargain purchase. Sure. Purchase consideration, I understood. What was purchase consideration? The amount of consideration, whatever I paid to acquire the business. Okay. But what is this non-controlling interest? Quite a new term, right? Let us discuss on that. See, A is acquiring B. Okay. 80% acquired. Control is there? Yes, its control is there. It's fine. So it comes under Ind AS 103. Fine. So 80% of B is acquired by A. Now, what has happened to the remaining 20%? That remaining 20% is the small group of shareholders. They are called as minority interest or they are called as non-controlling interest. You don't have the power to control the entity, right? They are called as non-controlling interest. In fact, to be precise, they are called as the outside shareholders. Okay, they are called as the outsiders or outside shareholders. Now, we have to consider this NCI also. This non-controlling interest also we have to consider. See, acquirer is acquiring the business. Okay. Say, for example, 80% is acquiring. But when you take the assets and liabilities, you value them at 100%, right? We take the value of assets and liabilities at 100%, right? Now, NCI is a group of people. They are also part of that company, right? They are still existing, right? So they also have some rights on the assets and liabilities. Therefore, as far as the acquirer is concerned, he is liable to them, right? That is why this NCI is also considered while computing goodwill or gain on bargain purchase, right? So if the acquirer acquires less than 100% stake in acquiree, then the stake not acquired is called as the NCI. That is a stake held by the outsiders, right? So this NCI is measured with two methods. There are two types of methods. Any method can be followed. The first method is based on the proportionate share on net assets. Okay, proportionate share on net assets. And second method is based on the fair value. The second method is based on the fair value. So how to compute goodwill means there's a formula here. What is the formula? Purchase consideration plus your non-controlling interest minus the fair value of net assets, right? Purchase consideration plus non-controlling interest minus the fair value of net assets. We discussed here, no, the comparison here, purchase consideration plus NCI minus the fair value of net assets. So this difference, okay, whatever you get, if it is a positive difference, you will call it as goodwill. In case if it is a negative difference, you call it as gain on bargain purchase, which is nothing but your capital reserve, right? So these are some of the basics in your business combination. We discussed on what is this combination, right? Who is an acquirer, who is an acquiree. We discussed what is called as control. Then we proceeded further on what is business, wherein it is input, process, and output. Then we discussed on the accounting process of this combination, wherein the few steps are what? First is identifying the acquirer. Second is determining the acquisition date. Third is identifying the assets and liabilities. And once you identify, you have to measure them at fair value. Then you have to recognize the purchase consideration, that is also at fair value. Then we discussed on the non-controlling interest, right? Non-controlling interest can be valued at two methods. First is based on the proportionate share of net assets. Proportionate share of net assets. That means, say for example, here 80% is acquired, right? So how much is the balance share for NCI? 20%. So 20% on the net assets. That is called as your proportionate share of net assets. Then, so our second one is fair value, based on the fair value. So these are two methods given for NCI valuation. But if nothing is given, no, we can go ahead with that proportionate share of net assets. If the question is silent, you can follow proportionate share of net assets. Okay. Then we discussed on the computation for goodwill. PC is purchase consideration plus non-controlling interest minus the fair value of net assets will give you goodwill. In case the difference is negative, we call it as gain on bargain purchase. Is that clear to you? Let me discuss the illustration sums in our institute material so that you will have some, the formula you will be able to recollect and remember. Let me share the screen also. Yeah. Page number 168, it is illustration 1. Page number 168, illustration 1. A Limited acquires B Limited for rupees 9,60,000. Fair value of B's net assets at the time of acquisition amounts to 8 lakh. Required, calculate goodwill. Journal entry is the books of A. Now, A Limited acquires B for 9,60,000. Now, this 9,60,000 is nothing but your purchase consideration. But the question is silent on the percentage of acquisition. They have not mentioned anything. So when percentage is not given, we will not be able to arrive at what is NCI. So ignore NCI now. Okay. Then fair value of net assets, they have given it as 8 lakh rupees. Now, what is the formula for our goodwill? It is PC plus NCI minus fair value of net assets. NCI is silent in the question, so we'll ignore it. Therefore, PC minus net assets. Therefore, 9,60,000 minus net assets of B Limited is 8 lakh. The difference being a positive one is 1,60,000. Therefore, this is called as what? Goodwill. Okay. I hope you remember the formula now. It is PC plus NCI minus your fair value of net assets. Okay. Now they have asked you to prepare the entries, journal entries in the books of A. Now A Limited acquires. So A is the acquirer. In the books of the acquirer, they want you to pass the entry. Okay. Now before saying the entry, just imagine A is acquiring the business. When you acquire the business, what is coming inside? Assets are coming, liabilities are coming, right? Goodwill is there, and then you pay some amount of consideration. right? Now, in this question, they have given you the fair value of net assets. Means you don't have the split of the assets and liabilities separately. So what we can do, we can take the entire amount as net assets account debtor. Okay, net assets account debtor, rupees 8 lakh. Point number one. Second is what? Goodwill. In this question, there is goodwill. Therefore, goodwill is an asset. So, goodwill account debtor, rupees 1,60,000. To consideration. What the purchase consideration is going to pay? 9,60,000. To consideration account, 9,60,000. Now, we discussed that the purchase consideration will be paid either in cash or shares or in kind. Now, the question is silent on how the consideration is being paid, right? In case the question tells you that consideration was paid in cash or A acquires B Limited by cash, in that case, the term cash is given, no? So, we'll pass another entry called as what? Consideration account at 9,60,000 to cash account 9,60,000. Right? So this thing is not given the question. So we are leaving it as such. So the only one entry we are going to pass, which is net as account at 8 lakh, goodwill account at 1,60,000, to consideration 9,60,000. Right? Let us go to the second illustration. K Limited acquired L Limited. Right? That question. Illustration 2. On March 31, K Limited acquired L Limited. K Limited issued 60,000 equity shares, rupees 10 par value, that were trading at rupees 240 on March 31. On March 31, the book value of L Limited's net assets was 72 lakhs on March 31. The fair value of net assets was assessed at 135 lakhs. So acquisition journal entry under Ind AS 103. No, K Limited is acquiring L Limited. So K is the acquirer and L is the acquiring. Okay, first thing is done. Issued 60,000 equity shares at 240. Now, what is this? The consideration being discharged as shares. Okay, what's the per price? 240. Whereas the par value means the face value is rupees 10. Right. Then book value of the net assets was 72 lakh. The book value means the balance sheet figure was 72 lakh. The fair value of net assets was 135. Now tell me which you should consider. When book value and fair value is given, we should always give importance to the fair value. Please don't forget, it is always the fair value for Ind AS. So fair value of net assets should be considered. Okay. So let us proceed to the solution. What's the formula? It is PC plus NCI minus fair value of net assets. Again, here the percentage of acquisition is not given. So NCI, we are leaving it aside. So we don't know NCI. So purchase consideration is how much? 60,000 equity shares at 240. So multiply 60,000 shares at rupees 240, which is 144 lakhs, minus fair value of net assets. Minus fair value of net asset is 135 lakhs. The difference being it is goodwill. Now, how will you pass the entry? Net asset is 135. Net asset is 135. Goodwill account data 9 lakhs. Then to consideration 144 lakhs. Journal entry is what? Net assets account data, goodwill account data, to consideration account. Now in this question, we know how the consideration was paid. So let us pass another entry. Consideration account data 144 lakhs. How many shares are issued? 60,000 equity shares are issued. Always remember, the equity share capital should always be at face value. Equity share capital should always be at the face value. Therefore, 60,000 shares, you will multiply it with the face value of rupees 10. Therefore, equity share capital is 6 lakh. Right? The balance 240 was the market price. So 10 rupees the face value. The difference of rupees 230 is what? Your securities premium. I hope you people remember these transactions from your company accounts and audit. So 2 securities premium is 60,000 shares into 230. 60,000 shares into 230, which is 138 lakhs. Right? So consideration is paid as what? 2 equity share capital 6 lakhs and then 2 securities premium 138 lakhs. Right? So one more sum I want to discuss. Illustration 7. Illustration 7, please. It has NCI working. C Limited acquires 60% share in D Limited for cash payment of rupees 3 lakh. This amount was determined with reference of market price of these ordinary shares before the acquisition date. Calculate NCA and goodwill following fair value approach. Then second one is proportionate share of identified net assets acquiry approach. When on the acquisition date, the aggregate value of these identifiable net assets is 4,40,000 and 5,30,000. So the question here is C is acquiring D. Okay, acquire 60% share, which means NCA is how much? 40%, right? Then for cash payment of 3 lakh, which means what? The consideration value was 3 lakh. Now they have given you two cases. Okay, two combinations they have given for fair value of net asset. First case is 4,40,000. Second case is 5,30,000, which means when the fair value of net asset is 4 lakh, you are supposed to calculate NCA and goodwill. When fair value of net asset is 5,30,000, you are supposed to calculate NCA and goodwill. Okay, but NCA also they have given you question as NCA also they want you to calculate both the methods, proportionate share of net assets and fair value approach. Both they want you to calculate. So it is 4 different combinations you're going to see now, right? So first we will discuss on the share of net assets. Okay. So first we'll discuss on share of net assets. Then we'll come back to fair value. See, proportionate share of net assets. The first case is what? When the net asset value is 4,40,000. The second case is what? When the net asset value is 5,30,000. What was our formula? Consideration plus NCI minus fair value of net assets. How much is the consideration is paying? 3 lakh. 3 lakh is going to be the same for both the cases. Okay. This we are doing for NCI under proportionate share of net assets. I'm repeating again. NCI under proportionate share of net assets for both the value of fair value of net assets. Okay. Now consideration is 3 lakh in case of 1 and in case of 2 plus NCI. Okay, plus NCI. Now when it comes to NCI, proportionate share of net assets means how do you compute? Take the fair value of net assets. Okay, on that apply the proportionate share. How much is the NCA share? C has acquired 60%. So how much NCA is holding? 40% they are holding. Therefore, 4,40,000 into 40% is 1,76,000. Similarly, in the second case, net asset value is 5,30,000. This 40% is same. So 5,30,000 into 40% is 2,12,000. Okay. Sum of these two figures, 3 lakh plus 1,76,000 is 4,76,000. 3 lakh plus 2,12,000 is 5,12,000. Now, what is you have to reduce? The fair value of net assets. Now, fair value of net asset is 4,40,000 and then 5,30,000 here. So, 4,76,000 minus 4,40,000 gives you goodwill to the extent of rupees 36,000. In the case of second one, 5,12,000 minus fair value of net assets 5,30,000 gives you gain on bargain purchase rupees 18,000. See here the difference is negative. So negative means you have to treat it as gain on bargain purchase. Right? Now we'll do the first one. What's the first one they want you to do? The fair value approach. See, generally, fair value approach means in the question, they would have given you the figures directly. NCA at fair value, so on so. NCA at fair value, this figure, they would have given the figure directly in the question. Now, have they given any fair value figures for NCI? No. But they want you to calculate at fair value. How do we do that? See here. So consideration plus NCI minus fair value of net assets. So consideration is the same. So case 1 is 4,40,000, case 2 is 5,30,000. Consideration is same 3 lakh and 3 lakh. Now NCI at fair value. There what we did, we took the fair value of net asset and we applied the percentage of NCI. That was the NCI figure, right? Now here, how do we do it at fair value? See, 3 lakh is the consideration paid. For how much stake? 60%. So for 3 lakh, for 60% stake, it was 3 lakh. For 40%, it is proportionate working. These mathematics and all you would have done in Inter for FAC and company accounts and all. The same mathematics you're going to use it here. For 60%, the consideration is 3 lakh means for 40%, how much is the value? So 3 lakh into 40 by 60. Therefore, your NCI is how much? 2 lakhs. Same for case 2 also. Because the same percentage is not changed, the same percentage. There what happened? The value of net asset is different. Therefore, your NC would have got changed in case number 2. Here it is not going to change. The same 2 lakh and 2 lakh. Is it clear? I'm sorry. So fair value is for 60% acquisition by C, the consideration paid by C was 3 lakh. Now for 40, how much is that fair value? It is 2 lakh. Okay. So 3 lakh plus 2 lakh, it is 5 lakh minus fair value of net asset is 4 lakh 40, giving us a goodwill of rupees 60,000. Whereas in second case, 3 lakh plus 2 lakh, 5 lakh, whereas fair value of net asset was 5 lakh 30. Therefore, the difference of 30,000 is your gain on bargain purchase. Is that clear? So when it comes to NCI, you must be clear in two things. Identify the method of valuing NCI, whether it is proportionate share on net assets or it is based on the fair value. Proportion of net assets means just take the value of net asset and apply the percentage of NCI's hold. That's it. Okay, whatever figure you get, that's what is your NCIS. Okay, then you can sum up that PC plus NCI minus the fair value of net asset. That will give you goodwill. Positive means is goodwill. Negative means is gain on bargain purchase. If it is at fair value means, please be very careful. Check for the question. Okay, whether they have given you the fair value directly in the question. If they have not given means, do this methodology. For 60% is 3 lakh. For 40%, how much is the value? Is that clear? This is how we have to compute the value of NCI under both the methods. The question is silent. You can go ahead with the proportionate share of net assets. Right? Thank you so much.